Hello, everyone. Welcome back to Collier Bristow's US UK podcast. This is the second half of a two-part episode looking at life insurance planning with Christian Vandenhout of Vie International. If you haven't listened to part one, I'd encourage you to do so first, because Christian and I had a lovely discussion about life insurance, what it is, and some of the key issues involved with putting it in place. Christian, how are you again?
Yeah, very good, Aidan. Thanks very much for having me on again.
Marvelous. We're going to turn from what we've been discussing thus far, which is largely pure life insurance, he says in inverted commas, the sort of life insurance that people think about when they're the man on the street thinking about life insurance, and turning more to life insurance as a more sophisticated estate planning tool. And Christian, I know, because I've had the pleasure of being in your company many times and hearing you and your colleagues talk about what life insurance as a kind of product can do from an investment management and financial planning sense. Could you talk to the wider use of life insurance in estate planning rather than just a material, risk and death benefit discussion?
Yep. So I think in the first episode, we talked about how term and more permanent life insurance is used. And these are products that, for purposes that are suitable for UK, have zero cash value. There are life insurance policies that also have an investment component built within them. So there's an internal savings or investment component. I will start there, then we can talk on, the conversation will focus more on products which have a greater weight to the investment side.
Sure.
So again, high level, in the UK, you have term and whole of life, which essentially is like term to age 120. In the US, you have term, but then you also have their permanent life insurance products. Now, most of the permanent life insurance products in the US actually have intentionally an internal savings component, an internal cash value, which is actually why that word cash value is sort of used interchangeably in the US to describe their permanent products. Broadly speaking, there's probably about half a dozen main ones: variable universal life, VUL, equity indexed universal life, cash current assumption UL, and US whole life. Very confusingly similar name to the UK, but in those products in the US will have varying degrees of investment features and can grow cash value internally in different ways. One of those products, known as variable universal life, has been particularly popular in recent years in the US. I flagged that because the US compliant offshore bonds that we can talk about in a moment are known as private placement life insurance. One of the most common versions of that product, it is essentially a variable universal life, a VUL, but just not offered in a retail setting. It's offered to sophisticated investors or accredited investors. They're typically clients who are going to have assets of $5 million or $200,000-$300,000 of annual earnings per year, and are having to attest to that.
So can I just stop with this, just to make sure I understand, because this is one of the points where I start to then go slightly cross-eyed when it comes to life insurance. Let's say I've got £1,000. May keep it a smaller number. I've got £1,000, and I put £1,000 into my life insurance policy at the beginning, and then I put another £1,000 into the next year. There is an element of that £1,000 which is going to be invested, and thus it's not just the premiums I've paid are not just sitting there in a bank account somewhere with the life insurance company. That money is itself growing. Is the purpose of that money growing to give the insurance company some profit if I die prematurely, or let's give them a profit, hedge against if I don't die prematurely? Or is that investment growth mine as the policy holder because it's my money I'm investing?
Great question. So these plans, cash value plans, are really popular in the US. And you can comment on why they don't really work in the UK. But in the US, for clients who are US residents or who are leaving the UK and say, I'm leaving this year, I'm leaving in 3 years, and I want my plans entirely optimized for US purposes, these plans work really well. And so what happens here is you typically, to use your example, let's say you're paying $1,000, the annual premium is $1,000. That will go to cover the guaranteed death benefit. So you still have the guaranteed death benefit portion, and that is going to be guaranteed in the same way you would expect any normal plan to have a guaranteed death benefit. And then there will be surplus premium dollars beyond what is required to cover the insurer's mortality expense charges and to guarantee that death benefit. There'll be surplus premium dollars left over that will go into an internal account, an investment account, that the client, depending on the product that's chosen, will have different investment features that can be chosen or elected. And then that internal investment component is not guaranteed. That internal investment component is the value is dependent on essentially market performance. You can have hedges and floors and things like that to reduce the effect of recessions, etc. And why those are so popular in the US is because these policies, when issued under US compliant life insurance regs, that internal investment component grows income tax deferred. And then they're very popular because then as clients get older, they can draw on that internal cash value, income tax free in the US, and use it to supplement living expenses, retirement costs, second or third home purchases, or a big one is always college education funding.
Right. So it is akin to, and I appreciate that this is not your area of speciality, it's definitely not my area of speciality, but in the same way that someone is prepared to take that whatever that surplus chunk is, and they might put it into their IRA or put it into their pension, and it's going to grow cash free. It's the same sort of, at its very basic nature, the same sort of discussion about putting your money there is useful because under US regulations, the IRS has decided that it's good for that money to grow tax free, and thus that's why it's an attractive product rather than holding your money in a general investment account, and it grows subject to tax.
Exactly. So for a lot of people, it will be it's another avenue to grow savings in a very tax efficient way, and also to be able to access those. You don't have to wait until a certain period. Retirement accounts don't have penalty charges to access funds, etc.
I guess the reason why my brain often has this disconnect is, why are these two things linked? Because life insurance is a thing. There's a company who's taking a risk on whether I die or when I die, sorry, and there's a cash value associated with that, a death payout associated with that. And then separately, someone's saying, oh, but any surplus you can have can be invested. Those two things to me seem entirely incongruous with each other. They're sort of entirely separate things that have been sort of put together. You may not be able to answer this question. The answer is it is what it is. But why is there this investment opportunity within a life insurance wrapper? Because to me, they seem like different things.
They serve slightly different needs. I'll tell you that the insurance companies prefer these permanent plans, these cash value plans, rather than plans that don't have any cash value and look, frankly, like UK whole of life, which is often what we have to restrict ourselves to sourcing and design policies in such a way that they don't have cash value to work the UK terms. But the US insurers prefer those products. They're more profitable for them because the cash value component or the investment risk actually shifts, at least for that portion, to the client. And they're more profitable for the insurers. And now that these, over the decades that these products have become popular and they make money for the insurance companies, there's a very powerful lobby, insurance lobby in the US, and I don't see those disappearing anytime soon.
The moment you started talking and giving your answer, I thought, the obvious answer is it makes people more money, and they're a powerful lobbying group, and they want to incentivize people. They want to incentivize government to keep them in place and incentivize people to use them, and therefore government, in wanting to incentivize people to use them, gives them the tax relief. Yes, I have heard before about the power of the US insurance lobbying market.
On this point, they had some rules and regulations that were issued years ago where they felt that there was abuse of these insurance contracts where too much money was being put into them too quickly. And essentially, they were looking more like pure investment contracts.
Yeah.
Because you were getting all of this income tax deferral, or income tax free growth, I should say, not deferral, income tax free growth. And that clearly was the primary motivation for doing this. So they have what's known as the MEC rules, modified endowment contract rules, which very briefly, it stops people from putting too much money in too quickly into one of these insurance contracts.
That makes a lot of sense. No, I can see that now. You've teed up two different things, and I have no preference as to which one you want to discuss. I think we should cover both of them in at least in some high level for my poor simple lawyer's brain. You mentioned bonds and you've mentioned PPLI. Maybe let's think of it this way: to the US market in the UK, which of those do you see on a more frequent basis, and or which of those are thus ones that you want to discuss with greater urgency?
Yeah, so in one sense, I think you can answer this and think of them, answer it in the same discussion. So offshore bonds in the UK are used quite widely for gross roll-up on the investments.
Yeah.
Where we typically get brought in, certainly a large portion of your client base, is when there's US connections. And so then we need to help ensure that clients' financial assets, their financial plans, including their life insurance, is also US compliant.
Mm-hmm.
I suppose that the simple starting point is offshore bonds from your typical, Isle of Man, Ireland, Luxembourg, etc. sort of providers. The vast majority of them are not going to be US compliant.
Yeah.
And as most of our clients are US citizens or taxpayers who need their plans to be US compliant, it's a non-starter. You often hear people talking about, being in things like Utmost or various other popular insurance wrappers that provide their investments gross roll-up. But that might be gross roll-up from the UK perspective, but it's not going to provide that from a US perspective.
Again, we're coming back to me trying to make sure I understand the intersection between how the life insurance kind of slots into this machine. The bond at its most simple, basic premise, I'm going to assume people listening to this discussion have a vague understanding of what a bond is. Where does the life insurance part of a bond come in? Because if I go and buy myself bonds as a regular man on the street, there's no life insurance element to it. At least as far as I'm aware, there is. So how does the life insurance get inserted into the conversation with an offshore bond?
Offshore bonds that I've seen have negligible life insurance. It might have £100 or something like that on top, and is it issued by a life insurance company? It should not be confused with it. It is entirely about the investments.
Yeah,
and it stops there. So rather unhelpfully, it's known as a life insurance bond. This
is why I'm confused.
It's entirely separate to entirely distinct from what we've been discussing earlier, where there's real risk shifting to the insurance company or ultimately the reinsurance company, whereby they are on the hook to pay out a larger death benefit if someone dies.
Mm-hmm.
So offshore life insurance bonds, they typically don't have those. That component. Fine. It's essentially an income tax free chassis around your investment.
Fine.
And very popular for European and for UK purposes. But as with so many things that we deal with, it's not US compliant. So then for our clients who are US and maybe UK citizens, are there solutions that are compliant for people who have both US and UK tax consequences?
And just, I guess, final then sort of point about me harking on this as the layman in this conversation. You said finding solutions. This may sound like an obvious question, but what is the objective that you as the advisor are trying to solve? I appreciate there's going to be a lot of different objectives when we are thinking about these more sophisticated financial instruments. Are we just talking about, ultimately, our clients? This is another way for clients to have their wealth increasing in a tax efficient manner? Are we thinking about ring fencing assets and putting them outside the scope of estate tax in the US, let's say, inheritance tax here in the UK? Or are there non-tax mitigation solutions here where these financial instruments are particularly useful over, say, the other competing accounts and opportunities for wealthy people to put their money into, like their pensions, their IRAs, and other sorts of things? What's the specific, or are there specific reasons why this sector of the financial planning market is particularly useful for Americans in the UK?
I would say that there's actually quite a new recent change in the proposed budget for the Conservatives around removing protected settlement status.
Mm-hmm.
I've already had a number of inquiries from from other advisors in the UK where their clients have assets in offshore trusts that, from their perspective, were not going to be, because the timing and the way in which they were settled have not been subject to income and gains from a UK perspective. Now, it seems that if the proposed legislation goes through in its current form,
we should stress, by the way, at the point of recording, we've had the proposals. We have not yet had the legislation. It's not yet been passed. So we are speculating based on what the government announced in its budget. I say that depending on when this broadcast eventually goes out.
Yeah, no, and good point. And it's likely to be changed in some sense, or the timing of the implementation of the rules, etc., to shift. But this just gives you an example of where there is a need, where these types of plans can genuinely help. Is you can then have so you have assets that had been settled into trusts that were not subject, or have not been subject, to UK income and gains, which, if proposed legislation goes through, would be. And you can potentially look at having these offshore trusts take out a private placement policy, an offshore bond, if you want to call it that. But frankly, the private placement policies are just more sophisticated. That can be designed in such a way that provides income and gain tax-free growth, and you have your discretionary investment manager and a totally bespoke investment mandate. So it can act as a blocker on the income and gains where trusts had earlier provided that, and which going forward may not in certain circumstances. I suppose a little bit like UK resi property for a long time was structured, and I'm sure you and your firm had been very busy with this, had been structured, held in offshore trusts and corporate structures, and that provided several benefits, but one of them was the IHT blocker. And then that benefit was removed years back, and more quickly in the conversation, there was still at least some privacy benefits. So then there was the trust register, which probably chipped away at that. And there was still a fair amount of annual administration cost for not very much benefit anymore. So my experience was that much quicker, much earlier on in the conversation with lawyers, life insurance was brought up to achieve an IHT blocking, or not IHT blocking, but to achieve a solution where you're providing liquidity to settle IHT in quite a simple way.
Yes.
Without other
adverse tax
structures
consequences.
Yeah, exactly. As opposed to other avenues which didn't necessarily achieve the outcome anymore. So a little bit like that. I think we're certainly having a lot more inquiries around how those private placement life insurance policies can work to act as income and gains blockers for protected settlement trusts that there's concern that they would lose that right in the future. So we're sort of now talking a little bit about private placements. So just to, if this is a good time, just to explain a little bit that.
Please.
So private placement, it was sort of became popular in the US, I think in the 90s. And then there were regulations that were issued and rulings in the 2000s as it became increasingly popular. These are essentially hybrid products that combine, and this goes back to your point around, it's a bit confusing. It's life insurance, but there's also an investment component. But these are really trying to have the best of both worlds, where you can have insurance products that have real death benefit, life insurance on top, the way that we would conceive of traditional life insurance. If you die, there's quite a large death benefit versus what you've been paying in. But then separately, there is also the ability to benefit from tax-free growth on the investment inside the policy. These are very technical. To be able to benefit, to sort of have your cake and eat it, they have to follow quite strict rules on the funding, the amount of life insurance that is added on top, for which there is a cost. There's probably a couple different types of policies, but it's going to be a little bit technical. I don't know time-wise whether we want to go in, but I can say the names. And then one is a non-MEC PPLI, which includes multiples in death benefit over of the investment components. So if you put 10 million into a investable premium into a contract, it might buy 30 million of death benefit on top, for which there's a cost. But from US perspective, you would be able to access all of your original premium capital basis immediately income tax free.
Yeah.
And you can also access the growth, the gains in those contracts income tax free. Obviously, I should be very clear. I don't think we'd specified this earlier. Not a tax advisor. So you would be looking to individuals such as yourself and on the US side to affirm this. But I can talk about the widely understood tax treatment of life insurance to be confirmed based on anyone's individual circumstances. You can have policies that allow income tax-free access to, from a US perspective, to the growth, and can also, when someone dies, for the growth to pay out without any income tax on it. You don't have that in the UK, is my understanding.
Yeah.
So with UK rule, great, you get the gross roll up, so no income and gains on the growth. You can access the basis, the premiums, 5% a year over 20 years.
Correct. Yeah.
But then if somebody wants to actually access the growth, then it's going to be a taxable event.
Correct. Life insurance and the taxation of these sort of life products is one of the trickiest areas that you'll ever find in an estate plan. And while we relish the opportunity, I'd be lying if I said every time we have to deal with it, you don't sort of have to steel yourself to remind yourself again about how precisely chargeable event gains work and those kind of things. I'm conscious of the time that we have left. I do just want to touch on something that we have kept teeing up over the course of this two-part episode, which is we keep saying life insurance policies in trust and talking about the consequences of not being in trust can actually be dealt with in a fairly swift way, which is exactly as you said earlier, Christian. If you have a policy over which your life is the life assured and the policy is not held in trust, assuming you're the policyholder, which would be the common default position, the policy forms part of your estate for estate tax purposes in the US and inheritance tax purposes in the UK. So you need to put that policy somewhere where it's not going to arise in your estate the moment before you die, as the way the policy would work. Now, that either involves giving that policy to someone else, and that has certain consequences to it, or much more commonly, putting the policy into a trust, particularly efficient where the policy has no value until it's matured, exactly as you said. In the US, they refer to that as an irrevocable life insurance trust, or an ILIT, ILIT, and in the UK, we just refer to it as a life insurance trust. I do exactly as you do all the time. I say to clients, if they are very non-Americans and very sort of otherwise straightforward estate planning, I say, ask your life insurance company if you haven't got a trust already. They may have a boilerplate that you can use. They may have some very simple trust document you can use. That might be suitable for you. It might not, for reasons that we can discuss with them, but it's a good starting point, particularly if the policy is a simple, pure life, maybe joint life, second death policy or something like that. That policy, though, as I've always been told by many of our colleagues in the US legal and tax space, those trusts will not be good trusts for US purposes. They will not be ILITs. Because ILITs require a greater level of sophistication and mechanism around them in order to qualify as a life insurance trust. And it involves giving out things called crummy notices and doing other sorts of, hoops you've got to jump through in the US market. And so the general position for Americans in this space is you can't just rely on a bog standard UK life insurance trust. You need something more specific. You either need to get a policy written for you in the US, or you need to source some other form of trust that qualifies as an ILIT in the US. And then we in the UK need to confirm if you're a UK resident and or domiciliary under the current rules, that policy going into trust in the US and staying in trust in the US is also going to be tax efficient from a UK inheritance tax perspective. There can be other tax consequences that swirl around pure life insurance, but that's the main thrust. The other thing I wanted to mention, which is to pick up something else that you said at some point over the course of our discussion, was about upfront life insurance payments rather than annual life insurance payments. As you said, it's my own experience, it's more common in America to have the opportunity to pay all of your premiums upfront in one go. That can be potentially problematic in the UK because, technically speaking, the funding of life insurance when it's held in trust is an annual ongoing contribution to a trust, which can have inheritance tax consequences. That is usually fine in the UK because that qualifies for one of our inheritance tax reliefs or exemptions known as the normal expenditure out of income, i.e. you're paying these premiums out of your surplus income. It doesn't matter how much you're paying, provided it comes out of your income. If it doesn't come out of your income and it doesn't qualify for another relief, those premiums could be taxable depending on how much of your 325 nil rate band that you have left. But if an American wants to fund a life policy trust and put $1 million into it at the beginning, let's say that's what the upfront cost is, they could be treated as adding $1 million to a trust. And if they're a UK domiciliary, the current rules, there could be immediate inheritance tax on that. And so Americans living in the UK need to be very careful when they're talking about fronting up all of the premiums in one go. I don't really want to get into the complex international sort of estate planning and tax consequences of having US policies and the consequences here in the UK, only to say they are complicated, and the ways in which UK tax can cut through them are a many-headed beast, and clients need to take detailed advice before they put such policies in place to make sure that whatever solution they're looking to achieve, that Christian and his colleagues have very kindly put together, does not have such a high UK tax consequence so as to render the solution no longer efficient. If there are tax consequences, so be it, but we put that on one side of the scales, and we need to make sure that the good side of the scale still remains sufficiently weighted, or we put in place a type of policy that is more suited to you, or we wait until maybe you've left the UK tax net before putting such a policy in place. Christian, from your perspective, anything else? I know you're not a tax advisor, but anything else on the kind of high level of life insurance taxation that I've missed there?
No, I think the point that you made around the funding is a big one. So this is always something, again, we don't give advice on it, but we're obviously very aware of where tax interplays with the planning. For a lot of our clients who are both forward in both the UK and the US tax net, that's always a concern. And in fact, I think I've been hearing more that there's HMRC is beginning to increase auditing of gifts from normal expenditure of income, and it's important to keep records around that. We do have some clients for whom, well, we'll have to see what the new rules come out as in the UK. But there was an element of, can you fund these policies and trusts before you become domiciled?
Absolutely.
To avoid the not the headache, but the ongoing compliance, checking of premiums for policies held in an ILIT, which would be a discretionary trust for UK purposes, falling within surplus income. We have clients sometimes who will, let's say they're earning $1 million a year and have lots of surplus income, look to short pay policies to coincide with their earning years. So it's more easy to demonstrate that they're meeting that test and avoid, going into retirement and having far less surplus income where they're living off of just a much smaller amount. Sometimes when discretionary trusts don't work, we've had clients where, in discussion with their lawyers, they pivoted to bear trusts for the UK, known as sort of nominee or family trust in the US, or very rarely flips FLPs, but typically the cost for that latter option isn't very palatable for a lot of people for typically the more routine type of planning we're discussing here.
I also realize, in commenting on the US position based on what I've heard previously, to reiterate the point that you made, which is, if an individual is comfortably under the estate tax allowance, then the consequence of not having an ILIT is the policy is going to fall into their estate for estate tax purposes, in the same way the policy would fall into their estate for inheritance tax purposes. We come back to one of the most oft-treaded paths on this discussion, which is the difference in value between the US estate tax allowance and the UK inheritance tax nil rate band. They are orders of magnitude different. 13 and some 14 million in the US and £325,000 in the UK. So the consequence of your life insurance policy falling into your inheritance tax net is a lot more significant for the average man on the street, let's say, than a headroom of $14 million. So it might be that some of those clients, say for example the everyday Americans that Lawrence Lee and I were discussing on a previous episode, they're actually more sanguine about the policy falling into their estate for inheritance for estate tax purposes, because they think, oh well, I've got a whatever the allowance is going to be now or after 2026, I've got plenty of headroom. I'm not going to worry about it. The risk-averse cautious lawyer would say you should always be worried about that because you don't know what the future holds. But clients will make that risk analysis themselves, I guess. Christian, thank you so much for joining me today and for your time on this two-part series. You very helpfully and very cleverly teed up, some juicy morsels for people to contact you about, where you'd only given them the names of some life insurance policies or some products, and they obviously need to now contact you to find out more about how they'll fit their circumstances. If people want to get in contact with Christian, I'm sure Googling Christian Vandenhout will throw up his name. I can't imagine there are too many Christian Vandenhouts that work in the life insurance sector. Equally, if you have questions about the taxation of your life insurance trusts or your life insurance products generally, feel free to contact me as well. Otherwise, thank you so much for listening. Again, please do leave a rating or a review if you've enjoyed listening to this podcast. And otherwise, join us again next time.